Dzień dobry Państwu. Ja nazywam się Paweł Bystrek w imieniu spółki Analizy Online. Chciałbym przywitać Państwa na corocznym wydarzeniu Fund Forum. Dzisiejsza konferencja jest już 11. edycją tego wydarzenia. Jest nam bardzo miło, że cieszy się wśród Państwa niesłabnącą popularnością i zainteresowaniem. W dniu dzisiejszym jest z nami gość wyjątkowy. Pan James Ashley, dyrektor zarządzający w Client Solution Group w Goldman Sachs Asset Management i będziemy mieli możliwość wysłuchania opinii tego światowej klasy eksperta na temat wyzwań, z którymi obecnie mierzą się inwestorzy zarówno na rynku akcji, jak i instrumentów dłużnych. Good morning, James.
Good morning. Great pleasure to be here.
It's a great honor to have you with us at the Fund Forum conference, and we are really very pleased to have you, very pleased to be able to talk with you in front of the cameras as well. We've prepared some questions for you and would like to know your opinion on some key issues. Firstly, thinking in global perspective, should current condition should be considered rather as risk factors or rather as opportunities to deploy capital?
Firstly, let me just thank you for inviting me to participate in this conference. Excellent agenda. It's a great pleasure to be here. On your question, obviously it's hard to disentangle the two. With any opportunity, there is normally a degree of risk associated with it. The question is, what extent are you willing to take that risk? And that obviously depends on your portfolio objectives. Are you in capital preservation mode? Are you on growth mode? Are you on income mode? So it's very much about the individual's investment objectives. The way we look at things from a multi-asset perspective is to say right now we think the market is a little complacent when it comes to the near-term outlook. There seems to be a consensus forming that the US will have a soft landing, that Europe will be doing okay. Our perspective on that is somewhat different. We think that the risks of a recession in both Europe and the US are somewhat larger than is anticipated right now. And as a consequence, when we think about how to position within a portfolio, we would be of the view that actually equity markets, you should probably be a bit defensive towards them. Now the question then is within that, where do we see the opportunities? If I take the US, for example, the rally that we've seen in the US equity market so far this year has really been fueled by what we're calling the Magnificent Seven companies, so the mega cap tech companies. If you look at the broader S&P universe, actually the rest of the 493 stocks have collectively delivered 1% returns. So the valuations that we see in those areas are a bit more, we think, connected to where fundamentals suggest they should be. So fundamentally, we would say you can be neutral when it comes to risk assets. There's probably a bit more value in rate markets right now, whether that's high quality credit, so investment grade rather than high yield, or short duration fixed income. But there are both risks and opportunities out there. It's how you navigate the two of them. What we haven't talked about, of course, is the non-macro factors. So there's a number of geopolitical risks that I think investors are going to have to navigate. That's something that we don't have any predictive power over, but it's very much on our radar of what we need to stay alert to.
Of course, the global perspective is a very complex issue. So, secondly, what are the two most important factors? What are the two most important pieces of advice you would like to you could give to Polish investors right now? Is it for Polish investors rather the time to take profits on their equity investments and move on to safe haven assets?
So if I'm looking at the valuations that we have in Polish assets right now, you could certainly say that Polish equities are relatively attractively valued. If you look at PE ratios of Polish equities compared to the US that we were talking about before, you'd say on a pure valuations basis, Polish equities look more attractive. Now, of course, you can't just do that. You have to connect it back to what extent is that reflecting macro fundamentals, risk factors, various other elements. So I think the valuation story perhaps favors Polish investors looking at Polish equities, but actually in an unconstrained way, we would see more value in Polish fixed income right now. So high quality fixed income in Poland relative to Polish equities. And if we're thinking about how do you manage the equity piece, we'd probably be encouraging Polish investors to diversify, to look overseas, to look at other regions instead. If with a blank sheet of paper we were to say how much exposure should you have to Polish equities, if you were completely neutral and just looked at the global benchmarks, the Polish weight within that is a fraction of 1%. And for many Polish investors, their exposure to Polish equities is far, far, far higher because of the home country bias that we see not just in Poland, but in most regions around the world. German investors hold a lot of German equities. UK investors hold a lot of UK equities. So if we were just going to say to Polish investors, what's the appropriate strategy right now? From an equity perspective, it would probably be to diversify beyond Polish equities. So the Polish exposure we would say right now, we would express through fixed income, and the equity exposure that Polish investors would be holding, we'd say look to markets beyond Poland to have some source of return from there.
And in terms of fixed income, should we rather take on short duration funds or rather take more risk?
So there it depends which region. If I think about obviously the nominal anchor for global fixed income markets is the US Treasury market. We've been of the view so far for the past year or so that you should be short duration, so maintaining a limited exposure to interest rate fluctuations. Given the sell-off that we've seen in recent months, that's been a sensible strategy, but we now get to a point where valuations start to become interesting. When we see the US 10-year at 450, 460, that's the point where we start to say maybe we can add a bit of duration back to portfolio. So up until now, we have had that bias towards short duration strategies. But I think the valuations that we're now seeing, and in conjunction with a point where we think central banks, for the most part, have probably peaked, and the question is when do rates start to come down, it begins to make sense now, we think, to add a bit of duration back in.
Mm-hmm. And the last but not least, could you please share your opinion on whether you think assets seen as alternative investments will become more important in the future? Should we, as investors, should focus on commodities, more complex strategies, kind of infrastructure ventures, or maybe somewhere completely outside? And the question is, will be forced to seek returns in completely different environment, or rather traditional equities and fixed income will still lead the stakes?
So if we were thinking about the basic building blocks of a multi-asset portfolio, we would still start with equities and fixed income. There are questions within that about how would we rebalance that? Should we change the exposure between the two? And then within equities, which regions or which styles? But the basic building blocks, the starting point would be equities and bonds. We've always been of the view that they should be supplemented, however, by various satellite asset classes, and they will include some of the things that you mentioned. So if we think about alternatives to begin with, we are very much of the view that alternatives, and we can define that in various ways, but certainly including private markets, have got a fundamentally important role to play in multi-asset portfolios. And that will only increase over time as we see the depth and breadth of those markets growing. So we're very much of the view that that's an important part of our diversified portfolio. The other piece you mentioned, infrastructure and commodities, our thesis is that the kind of inflation that we're seeing at the moment is certainly driven in large part by cyclical factors, but underlying all of that, there's also some persistent structural inflationary factors, things like demographics, decarbonisation, deglobalisation. And what that means is inflation is likely to be stickier at higher levels than we've been used to in recent years, and therefore increasing allocations to real assets that give you some degree of insulation from inflationary pressures. We think that's the way to go. So you can play that either through commodities, through infrastructure, or through various asset classes. But to answer your question, I think equities and bonds are the basic building blocks, but we should be supplementing that with both real assets and with alternatives.
And what about the weightings of those potential alternative investments? Should we think of the range of 10, 15% of our portfolio, or rather move to the other weightings?
I'd hesitate to be prescriptive on that. It very much goes back to where we started this conversation about what are your objectives. If you're about capital preservation, then you would come up with a different set of weights than if you're thinking about income generation or if you're thinking about growth. And of course, your time horizons matter. Are we thinking about a portfolio where you're looking to maximize value over the next 5 years, or do you have a 15 or 20-year time horizon? So there are a range of multi-asset portfolios and weights that we would associate with different investment objectives. And of course, if anybody wants to discuss those, then Goldman Sachs Asset Management would be very happy to have those conversations. So I think, going back to where your previous question was, equity and bond weights will certainly dominate any exposure that we would put in portfolios to real assets and to alternatives, but they are non-trivial weights that we would assign irrespective of what your investment objectives are.
Okay, thank you, James. It was a great pleasure to have you here.
My pleasure entirely. Thank you.
Thank you very much. Szanowni Państwo, my ze swojej strony zachęcamy do śledzenia relacji z wydarzenia Fund Forum na bieżąco w streamingu i zachęcamy gorąco do odwiedzenia naszej strony internetowej, gdzie będą mogli znaleźć Państwo materiały dotyczące poszczególnych paneli dyskusyjnych. Dziękuję bardzo.